This is one strategy that many business owners consider when buying a whole life insurance policy, and it's basically saving into the policy and then borrowing as much as possible back, including what they put in premiums plus growth, and essentially die with a balance outstanding. But they're doing it for a few different reasons, and I'll explain in this video. So let's just say this square represents your corporation, and you have a $10 million whole life insurance policy. So this is for the death benefit. So if you didn't borrow anything and you died, $10 million would get paid tax-free to your corporation. But this owner, over their lifetime, they've saved, say they've put in millions of dollars into this policy, and they've borrowed as much as they possibly can back. And with all the borrowing, all the interest, let's say it adds up to $7 million. So they have a $7 million outstanding balance from borrowing plus interest and everything. If they were to pass away, the life insurance company will deduct whatever is owing from the death benefit. So in this scenario, $3 million would get paid tax-free to the corporation because they're factoring the $7 million. So at first glance, it seems maybe a little odd, like the policy was $10 million, you're only getting $3 million. That kind of seems like you're shortchanging yourself. But a lot of families, I don't know, they don't want a huge lump sum of life insurance to be paid. They don't need it. They'd rather borrow against the cash value during their lifetime and actually use the money while they're alive. But another planning opportunity that comes from this, whenever a corporation is the owner and beneficiary of a life insurance policy and the money is paid, let's assume this individual lived to life expectancy. The corporation is going to get a credit to what's called their capital dividend account, their CDA. And the CDA is going to be close to, if not equal to, the full death benefit. So in this example, we'll assume it's equal to the death benefit. So the CDA credit they get is for $10 million. Now, what that means is $10 million can come out of the corporation as a tax-free capital dividend. But because only $3 million got paid tax-free to the corporation, this $3 million can come out completely tax-free through the $10 million credit. But if you minus the $3 million they've used, there's still $7 million of credit left. So they could have an additional $7 million of profits sitting in the corporation or other corporate assets that they can also elect to take out as a capital dividend. Assuming a 50% tax bracket, that's saving you $3.5 million in taxes, being able to pull $7 million of assets out of the corporation. So from an estate planning perspective, a tax optimization perspective, you might consider putting money into a whole life insurance policy, borrowing back some, if not all, during your lifetime. I'm not encouraging people to borrow and to go into debt, but if you're comfortable with this, you can pay the interest on what you borrowed, and then if you were to pass away with the debt outstanding, there's going to be a differential that will allow additional corporate assets to come out of your corporation tax-free, that way saving you a pretty substantial amount of tax in the future. So if you do have a whole life insurance policy, there are many ways to take advantage of it during your lifetime and use it. This is just one of them. You don't have to borrow the most you possibly can, but if you did, this could be somewhat of a scenario you could expect, and it's going to be beneficial to your estate as well as during your lifetime because you've borrowed whatever you put in principally, plus there's been growth. So you've been able to capture that during your lifetime, and then on the back end, there's also the death benefit as well as the capital dividend account credit.